Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, September 25th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are threefold. Number one, will China's recent stimulus be enough to propel Chinese stocks higher over the medium term? Number two, will China's recent stimulus be enough to propel global risk assets higher over the medium term? And then number three, is the U.S. consumer throwing in the towel on the U.S. business cycle? Our answers are the PBOC's decision to cut the one-year medium-term lending facility rate follows yesterday's 10-point monetary and macroprudential stimulus package aimed at supporting the Chinese Communist Party's 5% real GDP target and boosting investor confidence in the nation's stock market. Chinese stocks are up over 15% since our discretionary risk management overlay, aka Dr. Mo, pivoted 42 macro clients into a long max position proper trade recommendation last Tuesday. We believe Chinese equity outperformance is likely to continue over the medium term. Global risk assets are diverging from Chinese stocks amid mounting investor concerns regarding the effectiveness of a stimulus package that is light on fiscal support amid China's structural liquidity trap, otherwise known as a balance sheet recession. Investors should expect more R cuts in the months ahead if the PBOC is serious about supporting the flailing Chinese economy, which we believe it is. The September Conference Board Consumer Confidence Report was unsupportive of our resilient U.S. economy theme. That said, our industry-best empirical study of persistent leading indicators of the business cycle continues to signal a low probability of a recession over a medium-term time horizon. That view is further supported by easing financial conditions and a renewed positive fiscal impulse, the both of which are likely to overwhelmingly support high-income consumers in the U.S.'s egregiously and increasingly K-shaped economy. Transitioning to our 42 macro dashboard here. This one's, as always, we'll wrap up with the question from our community. This one's regarding spread products. It says, hi, Darius, good morning. Regarding dividend payments on BKLN, does the Fed rate change always affect the dividends on BKLN? In other words, in senior loans, senior secured loans are SOFR plus a spread, with the dividends of BKLN automatically drop with the Fed rate cut since corporate borrowers pay less interest on their notes. That is correct. So the only time you see the dividend yield in BKLN, which is senior loans, increase in the context of a Fed rate cutting cycle or low interest rates is when the actual underlying principal of the loan is being devalued in asset markets. And so 2011 was one such instance. 2016 was another instance, and 2020 was another instance. But by and large, the dividend yield on BKLN senior loans are leveraged loans are very much correlated to the Fed funds rate. So as the Fed continues to lower the policy rate over the medium term, it's likely that the dividend yield and the size of the actual dividend payments will continue to decline in BKLN. So investors should be aware of that. So we'll wrap it up there. Darius still presenting our macro minute for Wednesday, September 25th, 2024. Everyone have a wonderful day. Best of luck out there, and we will catch you back here next Monday. I'm going to be off tomorrow and Friday doing some traveling. So we'll catch you guys back here next Monday. Appreciate y'all. Have a great weekend.